And it's 1:30 p.m. and it's a weekday. That means it's time for update from the world of business. This is Business Incorporated. Here's what we have for you today. Well, United Arab Emirates has pledged $4.5 billion to support clean energy projects in Africa. And Kenya's stock exchange introduces 2 new market indices in a move to enhance its offerings to investors. More than 4,000 agricultural stakeholders meet in Dar es Salaam, Tanzania for the 13th Annual Africa Food Systems Forum. Welcome to the program as we start with the market numbers. Hope to have that in a couple of minutes right here. There you have it now. Nigeria, since the NGX, that is on fire. It's been on fire since last week. We see the numbers is up 0.11% at intraday. South Africa is, however, on the flip side, 0.98%. Egypt is, however, positive, just like in Nigeria, 1.00%, and Kenya is unchanged, negatively so, unfortunately. Now let's look at other parts of the market, starting from Abu Dhabi in the Middle East there, looking at these numbers. There you have it. Abu Dhabi is in the red, 0.79%. Dubai, almost 0.5% in the red. Not looking good for the Middle Eastern market at this time. Saudi Arabia still follows 0.39% in the red. Qatar, more than 0.5% in the red at intraday. Now let's move outside the market just for a bit. It's been less than half a year since Germany took its last remaining nuclear power plant off the grid, but that doesn't mean that the country can do without nuclear energy just yet. We have Lars joining us now to give us details of that. Hi Lars, good afternoon. Thank you for joining us. What's the current situation when we're talking about Germany energy markets?
Hello, Ini. Yeah, thanks for having me. It's really frustrating. We just got numbers for August, and it just so happens that last month, Germany imported more electricity than ever before, just over 6,500 gigawatt hours. It's because Germany cannot currently produce enough energy to satisfy its own demand, and there are a few reasons for that. The biggest one, obviously, when Russia started its war in Ukraine, Germany immediately halted all gas and coal imports from Russia. And those were actually a main resource for German energy production. Now, Berlin, of course, hurried to replace those Russian imports, largely by importing LNG from the US and other countries. But still, there is quite a gap, especially since the sanctions on Russia did not make the government reconsider its previous plans to get out of nuclear. Now, one has to know that exiting nuclear energy has always been a key goal for Germany's Green Party, and the Greens are currently part of Germany's governing 3-party coalition. And they wanted to stick to that goal, even as many experts said it would have been smarter to keep those nuclear plants running for maybe another 2 years or so. Much better, at least, than replacing their output with nuclear energy from elsewhere, or maybe even worse, with electricity produced in coal-burning power plants.
All right, but why can't Germany just import clean energy?
Well, because that's not how the energy markets work. When trading energy between two countries, it always comes out of an energy mix. And that mix currently isn't even all bad. 51% of the energy imported by Germany is actually from renewable sources. Hydrogen, offshore wind, onshore wind, photovoltaic, it's all there. But the energy mix also includes a full 21% of nuclear power, some gas, some coal as well. And just to make that clear, Germany has always been an active energy trading partner. For decades that's been going on. Sometimes Germany was an importer, sometimes an exporter. It always depended on how much energy was produced and how much was needed. But the balance right now is just unlike anything we've ever seen. And the bottom line is quite frustrating. After all, nuclear used to be 2.5% of Germany's energy mix, and it is now 4%. So getting out of nuclear power within the country has actually led to an increase in use of nuclear power after all.
So what about the markets? What's driving it? I wonder if those energy
Well, since we've been talking
moving.
Energy, let's have a quick look at the $85 per barrel this morning. That's up from under $70 over just the past 2 months. Energy companies are obviously doing well, as some companies in the natural gas sector, except maybe for Chevron. Shareholders there are worried about a strike that is likely to happen in the company's LNG fields in Australia over the next couple of weeks. As for the broader market, once again, China is setting the tone with a bit of a downward signal on Tuesday. Weak service data reminds investors of China's sputtering post-pandemic economy, all the problems there, and we've seen early indicators down for today's trading session.
All right, Salas, thank you so much for bringing us up to date. Clean energy needed everywhere in the world now. Enjoy the rest of your day. Let's move over to London now and see what's going on there. And we have Juliana joining us. Juliana, good afternoon. Well, I guess it's time to get update from that B&M striking a deal to buy 51 Wilko stores. So we've been talking about Wilko for a couple of weeks now, and I guess this is just another update on that.
Good afternoon, Ina. Yes, you're right. This is just a developing update to an ongoing story about the embattled Wilko store. I think the reason why there's been so much media interest in the UK about Wilko is because it's a store for those who don't have much money, and we are going through a significant cost of living crisis. So if you've got a few pennies in your pocket, Wilko is the kind of store that you would go to buy anything from tea bags to duvet covers. They fell into administration last month, and PwC have been overseeing the accounts and trying to find a bidder. Now, last week, there did appear to be light at the end of the tunnel, because a financial firm called M2 Capital put in a bid after kind of scratching beneath the surface of their accounts. PwC announced that basically they weren't fit to buy the stores, and 292 administrative staff were made redundant, effective immediate. There are over 12,000 staff and over 400 stores. And then, alas, this morning, during business morning, the news broke that B&M, which is almost a competitor, it is a British homeware retail store, sells very similar items to Wilko. In fact, their intellectual property is almost aligned together. They have bought 51 stores to the tune of £13 million. It appears as if the I's have been dotted, the T's have been crossed on that deal. And then there is a further development, which is back to the initial question you've asked me, Indy, and that is that PwC are apparently in the final phases of negotiating with a billionaire philanthropist who goes by the name, I believe, of Doug Powter. Now, anyone who's watching in the UK would be familiar with a store on the British High Street called HMV. Now, Doug Powter purchased HMV out of administration a couple of months ago, I believe. He also and his family, they own Toys R Us in Canada. They're known for going around the world saving high street stores. Apparently, he is in the final stages of discussing with PwC about taking over 300 stores. So that will be about 150 stores of the 400. I think about 8,000 to 9,000 jobs will be saved. But again, you know, this is a great story, and I think one of the reasons why there has been so much media interest in this story is because there are lots of families struggling at the moment, and any discount that you can get when you're out and about buying your goods is important. And Wilko, you know, is the poster child for that. So yes, 51 shops saved. Obviously not thousands of jobs, but a few jobs there. But potentially another rescue deal on the way via this Doug Putman, who is potentially going to buy 300 stores.
Yeah, I hope that rescue deal will increase the business activity, because we say it falls for the first time in the UK.
Yeah, that's right. We've had data from PMI, which is a forensic look at the private sector in the UK. And we've had pretty alarming data from the services sector. We know that services is crucial to the UK economy, contributing 80%. That's just how vital it is. And it's fallen. It's fallen for the first time since January below 50. So 50 is always the benchmark for PMI. So anything that's read above 50 is an expansion of activity. Anything below that is a contraction. It was at 51.5. That was the reading we got in July. And August's reading has come in at 49.5. Not great for the Chancellor. A bit of headache for them as they rejoin Parliament after a 6-week break. It's just showing that consumer confidence in the UK is waning. We did have positive data on Friday from the British Retail Consortium showing that sales were up and that people were out and about in the shops. But as I explained to Laddie this morning on Business Morning, you'll know, Innie, when the children are at home, people spend more on food. And that was why the retail reading was up. But when you have a forensic look, which is what the PMI has given us, it does show that consumer confidence is just not as bright as one would hope. There are a multitude of reasons for that. The main ones being the higher borrowing costs, the fact that, people are still being very cautious about where they spend their wages, particularly those who work within the public sector. Yes, negotiations are on the table, but industrial action is still very much taking place. So at the beginning of the year, lots of people in this country were talking about inflation, but as we are approaching, well, we're very much in the ember months, when it gets darker, it gets colder, it gets tougher. I think the word recession is something we're probably going to be talking about for weeks to come, Innie.
Yeah, I was hoping we would escape that word recession, not just in the UK, but globally. We've struggled with it for so much. But let's look at the markets now. I hope it's looking good.
It is looking great. The pound is not doing well against the US dollar because of that data that we got from PMI showing that the services sector has fallen for the first time in 9 months. But we got some positive data out of the Society of Motor Manufacturers showing that electric vehicle sales in this country are rising. That's significant because, of course, in a few years' time, there is going to be a total ban on the sale of any new petrol and diesel cars. So the fact that Brits are buying electric vehicles is good for the British government. That's topped up the blue chip index at intraday. It's up by 0.03%. That's the all share. The FTSE 100 is up by 0.08%. And the FTSE 250, the domestic market, that's up by that's actually down, by 0.15%. As I said, when the blue chip index is up, the pound usually falls. So it's trailing against the US dollar by 0.46%. £1 will just get you $1.25 at intraday. The British pound is also trading against the US dollar, the euro by 0.05%, but it's trading up against the Japanese yen by 0.02% in A.
Yeah, mixed sentiments right there, Juliana. Thank you so much for bringing us up to date.
Thanks, Innie.
Well, talking about the market, let's head to Kenya now, where the Nairobi Securities Exchange, the NSE, has introduced 2 new market indices, the NSE 10 share index and its N10, that's the way they want to indicate it, and then the NSE bond index, that's the NSE-BI, saying that the move is aimed at enhancing its offerings to investors. The NSE-BI, set to launch on October the 1st, 2023, will focus on the bonds market. It will be a weekly index distributed alongside the NSE yield curve. This index will be based on benchmark government bonds listed on the NSE. Importantly, it is expected to play a pivotal role in the issuance of fixed-rate feature contracts in the NSE derivatives market. The N10 index, which comes into effect immediately, will monitor the performance of the equities market, and this index will consist of 10 prominent companies, including Safaricom PLC, Equity Group Holdings PLC, KCB Group PLC, and others. It's worth noting that the list of constituent companies will undergo a semi-annual review, and the N10 index utilizes a market capitalization float-adjusted methodology and provides daily distribution. Welcome back to Watching Business Incorporated here on Channels Television. Guess what we are talking about today in the commodities segment? Burgers. Well, eating at home is embedded in Nigerian culture. However, out-of-home dining, which includes restaurants, hotels, fast food chains, bukas, mama puts, and other pub beer parlors, they've emerged as a new phenomenon in recent years. Food and consumption spending is estimated at more than 50%, about 56% of total consumption expenditure in Nigeria. With the current level of food inflation and squeeze in consumers' disposable income, well, do we expect to see a contraction in the contribution of food and fast food in particular to the GDP in any time soon, any recent time? Well, we have joining us for this conversation Adeye Adegusi to answer some of these questions. Hi Adeye, good afternoon.
Good afternoon, thanks for having me.
So do we see fast food and all of this, canteen, restaurant, do we see it increasing our GDP anytime soon, since it seems to be getting closer and closer into our culture?
Firstly, eating at home is held in high regard in Nigerian tradition, because it reflects family and togetherness. However, the dining landscape in Nigeria over the years has evolved with the establishment of dining outlets like restaurants, hotels, eateries, bukas, as you mentioned, and this is due to rising urbanization and the desire for convenience. But with the current price pressures and food inflation we have in Nigeria right now, it's going to impact the level of contribution to these fast food sectors, to these fast food companies, to Nigeria's GDP. Firstly, you have to look at if prices continue rising, also if prices continue rising, it will lead to lower consumer spending on dining out, on restaurants, because consumers become more budget conscious and will switch to more alternative, cheaper sources like regular eating at home, or patronizing your local buka that sells prices at cheaper costs. Then secondly, as I mentioned, the growth of these sectors has been directly linked to growing urbanization and desire for convenience. So whilst economic pressures continue to may lead to a reversion back to traditional in-home dining, the growth of this sector suggests that it has become a regular part of lifestyle, and particularly amongst urban dwellers and the young population.
So do we see this this outdoor food? Do we see them embracing substitutes in the face of increase in prices, as you have mentioned?
Oh yes, as I mentioned, as prices to illustrate this a bit, a burger that you buy for 1,000 naira 2 years ago, right now it will be sold at over 2,000 naira at a lower quality and also a smaller size. So this to make consumers like me, switch to other alternatives, and also street foods like akara, like bread and beans, all of this, to just to become more budget friendly and be more cost effective.
So looking at the increase in demand, or the more people embracing the culture of eating outside, and comparing it with the price hike, do you think more food chain industries will come into the country, or is it more of local companies growing, and filling that space?
A major impediment for international food chains coming into Nigeria has been, rising costs and supply chain disruptions, and also, lower average consumer spend in Nigeria. Because there are cases where you've seen major food brands from outside not wanting to come into Nigeria because because they most of these companies they value their brand, so they want them to meet consumer quality, to ensure consumer satisfaction and ensure their brand quality as well. So with these rising prices, and there are also uncertainties that local food supply may not be able to meet their quality standards, so which has hindered them from coming to Nigeria. But however, with Nigeria's rising population and the change in taste as Nigerians are becoming more exposed to international cuisine through travel and media, this could create a market for these companies coming into Nigeria.
All right, thank you so much, Adeye, for giving us insight into all of that.
Thank you.
All right, now moving on, let's go to Tanzania, where over 4,000 agricultural stakeholders have converged on Dar es Salaam, Tanzania, for the 13th Annual Africa Food Systems Forum. The summit themed Recover, Regenerate, Act, Africa's Solutions to Food Systems Transformation, is set to provide a platform to the delegations, leaders, and innovators from across the globe to discuss policy, breakthroughs, and innovations in agriculture and food systems transformation. According to a statement made available to journalists, the Tanzania Minister of Agriculture, Hussein Mohamed Bashir, says this year's summit places a strong emphasis on empowering women and youth, recognizing their pivotal roles in reshaping Africa's food landscape. He emphasized that the forum represents a significant milestone in the journey towards establishing inclusive and sustainable food system transformation throughout the continent. And the climate summit going on in Kenya has some good news for Africans. We hope to see it because the United Arab Emirates has pledged $4.5 billion to support clean energy projects on the continent. This was announced during the ongoing Africa Climate Summit in Kenya. According to a report, Abu Dhabi's clean energy producer, Master, Abu Dhabi Fund for Development, Etihad Credit Insurance, the nation's Exports Credit Agency, and Amir Power, a Dubai-based renewable energy company, will provide the funds. The Abu Dhabi Fund for Development will provide $1 billion of financial assistance. The Etihad Credit Insurance will provide $500 million of credit insurance to reduce risk and unlock private capital. Master is pledging $2 billion of equity and will mobilize an additional $8 billion in project finance targeting to deliver 10 gigawatts of clean energy capacity in Africa by 2030. We go to South Africa now and see what's going on there. Top on the list is that their GDP is out and the economy grew by 0.6% in the second quarter of 2020. Adjusted terms after growing by 0.4% in the first quarter. And that's according to the latest data from the Statistics Agency released today. The report by the Statistics Office shows that in the year-on-year terms, the South African economy grew 1.6%. 6 of 10 industries tracked by the Statistics Agency recorded growth in the second quarter, with agriculture and manufacturing sectors leading the way. While the agriculture industry grew 4.2% in the second quarter, manufacturing increased by 2.2%. The latter contributed 0.3% point to GDP growth, and the Economist poll shows that they had forecast the economy would grow by 0.1% quarter on quarter and 1.1% year. And just before we go, we can go to Kenya, and still coming from that summit, climate summit going on there, the country has entered into 3 environment-friendly trade investment deals with Sweden, South Africa, and Hong Kong, aimed at revolutionizing food security and air travel. This was during a sideline event at the Africa Climate Summit going on even as we speak. The deal with Swedish firm Cool Go Green involves tapping sunlight power food preservation in efforts to reduce food waste and post-harvest losses. The firm seeks to establish about 40,000 cooling units in the country in the next 5 years at a cost of $200 million. That's about 28.9 billion shillings. The firm's founder, Peter Corner, said that the deal will seek to empower farmers and Kenyans at large to leverage solar-powered cold rooms and containers to preserve food for a longer shelf life. It's estimated that up to 40% of food in Kenya is lost post-harvest due to high purchase and maintenance costs of preservation gadgets. Well, that's it on the program today. Thank you so much for being a part of Business Incorporated. A fresh episode awaits you tomorrow. I'm Ini John McQuarrie. Enjoy the rest of your day.